Welcome back to another episode of Living Fire. If you never want to miss an upload, make sure to subscribe to the channel. With inflation, it's the daily expenses such as food, fuel, and energy where consumers feel the pinch, and inflation is on the rise. Forecast to reach 1.3% in 2018, up slightly from 1.1% this year. While many people will see a salary increase as we head into the new year, its effect will be crimped as costs creep up. ECA International, an HR firm, predicted wage increases of 4% for 2018 in Singapore. Yet after inflation, the real uplift will be closer to 2.7%. While you can change inflation, there are simple ways to protect the dollar in your pocket. Here are some everyday measures you can take to soften the impact of price rises. Number 1, learn to love the Land Transport Authority. Fuel is expensive, and over the course of the year, it all adds up to a hefty bill. According to some reports, people spend around 2,600 Singapore dollars a year just on petrol. Before you add on the other costs of car ownership, such as road tax and insurance. Taking public transport could slash your costs in half. A monthly travel card costs 120 Singapore dollars, or 1,440 Singapore dollars a year, a big saving from the average annual fuel bill. Number 2, negotiate your salary. Notwithstanding the expected salary bump some employees may get, if you've been consistently hitting targets or taking on more responsibility than your job description sets out, this year may be the year to ask for more. If you're overdue for a pay raise, set up a time to speak with your manager to discuss the issue. Make sure you do your homework beforehand to make it easy for them to say yes. List all your achievements over the previous 12 to 18 months, targets reached, and other ways in which you have contributed to business growth. Research can also help your case. Find out the salary brackets for someone in your profession and your experience in Singapore to see whether you are on the right track. If your company can't give you a pay raise straight away, at least find out the timeline and what you need to do to get there. Number 3, checkout deals. Inflation does not affect all goods equally. In fact, the cost of food has risen faster than the general rate of inflation. The higher pace of price rises held true across all food types, from cheese and dairy to fish, vegetables, and fruit. Although purchasing no-name products and supermarket brands won't fend off inflation, not having the brand name attached will help in the overall lowering of the cost price. Number 4, be a green guru. Save energy costs by keeping an eye on your consumption. In our hot and humid climate, we all know air conditioners make up a fair chunk of a household's electricity bill. But by letting your house get a little hotter, you'll notice the heat from those bills dissipating. You could save 25 Singapore dollars a year for each degree warmer you have the aircon, according to the National Environment Agency. The agency recommends setting the temperature at about 25 Celsius. You can even make further savings by ditching the aircon altogether. A fan uses 1/10 the amount of electricity. Other handy tips to conserve energy include switching off appliances when you don't need them. Standby power accounts for up to 10% of home electricity use, and making sure you wash a full load on laundry day. Number 5, give your assets a workout. Make your existing assets work harder for you. When your account is really feeling the crunch, it may be time to consider more unusual ways to bulk up your bank balance. One option is to refinance your home loan. This is not a decision to be taken lightly. Still, it can unlock money each month if you find a provider offering lower interest rates than you pay currently. Make sure to read the small print of both existing and potential provider to understand and evaluate any costs involved, such as prepayment penalties, cancellation fees, or legal charges. Another option is to try and inflation-proof your savings. Check the current interest rates you receive on money squirreled away and what that translates to accounting for inflation. Manulife's saving options are a great way to protect yourself and your family against unforeseen price increases. Finally, diversify and see if other investments, such as gold for instance, give you good returns. Number 6, consider what kinds of bonds you own. Many investors, particularly as they near retirement and enter into retirement, will want some bonds in their portfolio. Bonds provide the anchor and the stability of a diversified portfolio. However, another word for bonds is fixed income, and the reason investors use the term fixed income is that the coupon payments in bonds are generally fixed. For example, if you invest $100,000 in bonds and get $5,000 a year in income, maybe that's a good return today and helpful for your retirement goals. But what about in 10 years or 20 years down the road? Will that $5,000 still provide you with the same lifestyle? Perhaps $5,000 isn't enough. Now with bonds, that income is often fixed. So how can that be mitigated? This can be done in a couple of ways. First of all, you can focus on short-term bonds. By focusing on shorter-term bonds, you have less exposure to future inflation. This is due to the fact that when those bonds mature, you can go out and buy new ones. What happens when inflation is rising is that interest rates tend to go higher as well. Picture yourself in retirement, and instead of a 30-year bond, you own a 4-year bond. Inflation is rising, your cost of living is increasing, and so are interest rates. In 4 years, when your bond matures, you take the proceeds and go out and buy a new bond at a higher level of interest. This generates more income, which will now cover your expanded cost of living. And that's the beauty of short-term bonds as opposed to being locked into a very long maturity bond. Number 7, Treasury Inflation Protected Securities, or TIPS. The second thing you can do with your bond portfolio is to focus on Treasury Inflation Protected Securities, otherwise known as TIPS. TIPS are simply government-backed bonds issued by the United States Treasury that have an inflation protection component. These are some of the safest securities in the world because since they are issued by the United States government, they're free from default risk. Effectively, there's no risk that the government won't be able to pay its bills. Even better, TIPS have an inflation rider, which adjusts the value of your principal along with the consumer price index. TIPS aren't perfect, of course. If interest rates increase, the value of TIPS, just like any other bond, can temporarily fail. However, if you want pure protection against both inflation and any risk of credit default, TIPS may be something to consider adding to your portfolio. Number 8, more aggressive types of bonds. Finally, within the bond space, some more aggressive types of bonds, such as high-yield bonds, emerging market bonds, and the like, may provide more protection against future inflation, as opposed to higher quality bonds. The reason for this is simply that the yield or the income generated by a high-yield bond is greater than that provided by a high-quality bond. Higher income will provide greater protection against the future cost of living increases. Of course, there's a downside, and certainly the recommendation would never be to load up entirely on high-yield or more aggressive bonds. As the name implies, a high-yield bond provides higher income, but also carries greater credit risk. Remember that the role of bonds in a diversified portfolio is to protect your portfolio. Bonds provide that anchor, giving you the ability to take a more aggressive stance in other parts of your portfolio with your growth assets. If you get too aggressive in your bond portfolio, maybe you have more inflation protection. What you're doing away with is that core value that bonds provide for giving you stability within your portfolio. Number 9, have stocks in your portfolio. Moving from bonds to stocks can also provide a great hedge against future inflation. Stocks provide inflation protection in 2 main ways. The first is that stocks often pay a dividend, whereas bonds generally pay a fixed amount. Specifically, if you invest in bonds today, your cash flow never increases. Dividends are different. As companies grow their profits over time, the dividends can also increase. If a company earns more, they pay more in the way of dividends. Those increasing dividends lead to higher cash flow in the future, which could potentially increase your spending power and maintain or even enhance your standard of living, even if inflation is rising. Imagine a scenario in which a company is growing their dividend by 7% a year. That's not an unheard of rate of growth. If your dividend starts at a 100,000 Singapore dollars investment, it provides 3,000 Singapore dollars a year in income. If it's growing at 7% a year, then over the course of a decade, you've effectively doubled your cash flow. You started with 3,000 Singapore dollars in income from those dividend-paying stocks. Now you have 6,000 Singapore dollars in income. That growth of your income can provide your hedge against inflation or maintain your purchasing power and standard of living. Growth of stocks. The second inflation-fighting component that stocks provide is growth. Over time, the stock market in general tends to move higher. Picking any one individual stock may or may not lead to a good outcome. Broadly diversified portfolios tend to move higher over time, albeit in a volatile manner. Yet, that growth and perch in your portfolio can lead to more purchasing power. You could invest a few $100,000 in the stock market, and over the course of 20 years, it could grow to $500,000. That's more wealth that you now have to maintain your standard of living, comparable to what you are living today, even if inflation has increased in the interim. And with that, we've reached the end of this episode, all about how to protect yourself against inflation. Do you know any other tips that we failed to mention? Then get involved and let us know in the comments section down below. If you enjoyed this one and found it helpful, remember to leave a like on the video and to subscribe to Living Fire for even more amazing videos just like this one. Thank you for watching, and we'll see you in the next one.